Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement here on the Max Out Savings Show. Our show is all about saving money, building up wealth, and understanding the world today. Our motto and philosophy is to save aggressively and invest conservatively. Save aggressively, save as much money as you can, and then conservatively invest it for the long term. That's the key to building up wealth, is save aggressively, invest conservatively, protect yourself in a world where at the present time we have over $39 trillion worth of debt in the United States, the federal debt. The debt is spiraling out of control. We're spending $2 trillion every year, a deficit spending. And the war with Iran is not helping out. And hopefully this is going to be behind us and we can move forward and start working to get that debt down. President Trump had a very good plan to do it, as we've talked about in this show. And then everything seemed to go off track with the war effort. And so hopefully here we are back in a situation where that's going to change. We'll have to see. This has been one of the more interesting markets I've ever seen, really. Looking out, looking at this war happened pretty unexpectedly, and people were, I say unexpectedly. It happened. No one was expecting it, and clearly there was preparations for the war ahead of time. Obviously we didn't get the memo, and most other people didn't, but it was. The markets, as a matter of fact, the day of the war virtually went down a little bit, and I believe the next day they were about even with virtually no decline. And if you look at it, there was a large amount of short selling the month before in the stock market, and so somebody was shorting large chunks of stock, and it seemed like once the war started, they appeared to be closing out their short at the higher level, and then maybe it was used to stabilize the market. I don't know, but the market ultimately ended up going down. Not really, barely 9% or something, and really one of the more milder declines we've seen in a long time in the face of really the worst case scenario in the Persian Gulf. And then once that President Trump declared the straits were open, the market has since rallied up in the last about 2 weeks. It's had one of the biggest rallies in history, pretty much. This is, if you look at it, this is the biggest recovery to all-time highs in a stock market. If a market's had a correction of 5 to 10%, this is the quickest recovery in the market to all-time highs since going back to 1928, which is really, they really don't have much records beyond that. And if you look at the sell-off last year, to hit new highs really took effectively from April 7th over. It didn't hit it till about really June, July, right at the end of June. So it took April, May, into the end of June. It took 3 months to hit a new high again in what this market took effectively less than 3 weeks to do. which is truly extraordinary. If you look at it, I think one of the things that the Nasdaq was I think an 11 sigma event, which is just like completely off the charts, and you almost never see happen. So just an incredibly strong market, and so we're going to cover what do we think is going to go from here. Why the big move up? I think a couple things. I think the Trump administration moved heaven and earth to keep the market from going down, to keep the public engaged, and so what normally in any reasonable market would be probably a 15 to 20% decline really just wasn't there. And so then the money came pouring back into the market. And, as of Friday, President Trump declared the Straits open. The Iranians said it were open, but supposedly today they've closed down again, but it's the weekend, so nobody cares until the market's open Monday morning. I hate to be this cynical, but that's sort of what we're dealing with, is just an incredibly volatile market. And so what you want to do is just kind of continue to navigate through it, which I think we've done very good job doing. But it's just it's just difficult to do. If you look at oil prices, the price of crude has fallen. The West Texas has fallen down to $85. It went as low as $80 from $115. So again, a huge collapse in crude prices. The problem, the issue we're still facing is if you look at the markets going forward, if you look at the market starting in let's say in February, a month before the market, the world has really materially changed in so many ways since then. If you look at it, back at the 1st of February, we had kind of a problem with the private debt, but it wasn't the private debt. It really wasn't that bad at the beginning of March. It was only beginning to understand we had an issue with private debt in the country. Since that's happened, most major private credit funds, private debt funds, private credit have gated their investors, and so they're letting out, I think, the 5% of the fund each month, but they're not letting in more. In almost every case, materially more investors want to get out of the fund than are being allowed out of the fund, and so the private credit is one of the big suppliers of credit to small and medium-sized companies out there, particularly private equity companies buying other companies, leverage companies. They're the guys lending to that. They've kind of taken all that away from the banking sector. And I was just actually going over a report this morning, which was, Byzantine, but looking at the balance sheets of the big banks. And one of the things that kind of jumped out, and I really only got through part of the report, but we do a lot of deep dives into financials and really try to stay at what's happening on those. But it's amazing how many, if you look at the balance sheet of the big banks, the percentage of loans on those balance sheets is materially less than most people think. I mean, it's well under 50% from what we've seen. And we're still going through the numbers and looking at it. But if someone would just ask me, what is a J.P. Morgan, Wells Fargo, whatever, Bank of America, well, how much on the balance sheet side of the equation, what percentage are loans on the books at the banks? Oh, I'd say 80-90%, and it was in many cases under 30%, which was surprising. And they have securities and other things. We'll get into that in another day in the show. But the private credit is a really big deal. So that didn't happen before. When the market was trading around all-time highs in February, it didn't happen. Okay, so now we're in a private credit crisis. Interest rates in February, there was no doubt in everybody's mind that interest rates were clearly going down, probably 2 to 3 cuts this year. Well, they were talking about rate hikes. I think that's kind of off the table. But really, since February, your rates have kind of come down about the same on the 10-year, but the really expectations is there's a potential for more inflation. Oil is up. It's not going down right away. Fertilizer prices are up 31%. Urea is up 51%. Sulfur's up 67%. Jet fuel's up 66%. And so there's a lot of inflation working through the system. The airline companies, even though many of them are hedged quite a bit, are falling all over themselves, raising ticket prices, and it's just kind of going through the economy. So we have inflation, which was quote dead in February 1st, is now coming back. And the question is, well, you said, Ted, oil prices, the war is over. Oil prices are $85. Probably by next week it'll be 70, and then it's going to go back down to 60. That's not the way it's going to work with this situation. Well, keep in mind, it's been a month and since this. It's a month and a half since this war has broken out, and if you look at it, you're talking about 7 weeks of the Straits of Hormuz shut down. It's a loss of about, some people say, 12.5 to 15 million barrels a day of oil production, and so it's seven. That's about 50 days of that. So if you put 50, you're looking at somewhere between about 600 to 750 million barrels of oil are off the market. And now some of that money has been made up, but some of that oil has been made up. But if you look at the Strategic Petroleum Reserve, President Trump did a very smart thing. He said, okay, we're going to give you this oil, but we want it back in 6 months, a year, year and a half. So going forward, there's the Strategic Petroleum Reserves need to be refilled. They're going to be refilled. A lot of countries go, oh, we had no idea we didn't have enough excess jet fuel or diesel fuel in a crisis, so they're going to want to have more capacity. It takes about 23 days to get the ships going from the Persian Gulf over to Europe or the United States, wherever they're going. And so it's been 50 days. So even now, it's still going to take 20 days to get the oil over to these places, assuming everything works out. And so what we're dealing with a lot of issues still to be worked out. There's 50 energy installations, terminals, the terminals of wharves, pumping stations, refineries, LNG gas liquefaction trains, all type chemical plants that have been hit over there. So those all have to be repaired. So we're dealing. To give an example, 10% of the world's aluminum production has been bottled up in the Persian Gulf for the last basically 50 days. Which means that aluminum production's off the market. Well, people are going to get aluminum for other areas of the market. If you look at jet fuel, I mean, think of the amount of jet fuel that the U.S. has been using on their bombing runs. Enormous numbers of planes have been flying back and forth. Even last week, there was just enormous amounts of C-17s and other big air freighters moving across to the Persian Gulf, still moving equipment in. And now that's going to have – so there's huge demand. So there's shortages. Europe has 6 weeks of jet fuel left there, and they're running out. And it's the same thing. Other countries, there's lines for diesel fuel in many parts of Asia now, in gasoline. There's companies are keeping their employees home. Airlines are still canceling their flights in the rest of the world. We're not really noticing it because we have so much oil and gas. But understand, there's a line of tankers, sitting outside of Houston waiting to pick up jet fuel, diesel fuel, kerosene, gasoline to move over into Asia or Europe. They're exporting diesel fuel and jet fuel out of New York Harbor, something almost has never happened, and moving it over to Europe. So this is not going away. So we have shortages of all types of components. We had a serious helium. I mean, who knew about helium shortage, which is used in everything from semiconductor chips to cooling magnetic resonance machines. So for imaging. So So a lot of these issues are coming up. There was plenty of supplies to last the first 2 or 3. It's been a month. It's been a month and a half. Supplies are running low. There's nothing new coming. And so you're going to see these things start cascading through the supply chain system. So there's the other thing that's happened. So we have a situation where we have inflation is going up. The supply chain is disrupted, materially disrupted. And then in addition, we also have the private credit situation, which we're dealing with. So it's a completely different market. So should the market be at all-time highs? Probably not. But there are opportunities. And tell you what, let's take a quick break and be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
This is the Max Out Savings Minute with Ted Gioka. Ted's on the line. Ted, the oil prices are skyrocketing, but there's some help down the line. It looks like it will come down. Enlighten us.
I think, Chuck, what we're looking at is we're still in the blockade. This is taking some time to work through. Oil prices are high. Probably still got a couple more weeks because they're bringing in so many tankers from around the world to take oil, gasoline, diesel fuel, and jet fuel from U.S. refineries elsewhere. So it's going to tighten up the market here. And the market has gone back up. Once we get things finalized with Iran, the market's still going to have to deal with supply chain issues, which are going to take at least into year end to kind of work through the system. So I think it's going to take some time, but we seem to be making a lot of progress with this war in the Middle East.
Well, that's real good news in the long run for us. Well, Ted, we'll talk about this, of course, anything that has to do with your money on the Max Out Savings Show this Saturday morning at 10 a.m. on AM 1070 and FM 103.3. The Answer. Thank you, Ted. We'll see you then.
Okay, great.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
AM 1070, The Answer.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. Here's a bit of good news. This came off through the Bloomberg. American Airlines says it's not engaged or interested in any discussions regarding a merger with rival United Airlines, dampening the prospect that an industry tie-up could reshape the industry. The United Airlines there's been rumors that they've been talking to people in the administration about buying American Airlines. Now, people in Houston, Texas, this is not their first rodeo with United Airlines. We had Continental Airlines in this town. Everything was great. It was a wonderful airline. Everyone was happy. The passengers were happy. The employees were happy. It was wonderful. United took over, and it basically all fell apart. And anyone that works at United will tell you that it was it's just a miserable place to work. I mean, they've improved, in fairness, but it was not Continental. And with American, at least you can zip out of Terminal A and not have to deal with Terminal C and everything else. and not have to deal with United. And if the United takes over AMR, that's going to leave only Delta and a few other airlines flying out, and which is going to raise up ticket prices in Houston even further. So it'd be a complete disaster for Houston. And so American says they're not interested, and hopefully our politicians in this town will also be lobbying to keep. I mean, because again, I understand United has a big hub here, but compared to Delta and American, it's, I've never forgiven them for taking over Continental. That was such a great airline, but here we are. But that's kind of the latest there. Looking at it's again we talked about just complete euphoria in the stock market, and then I get up this morning on X, and there's now the Iranians are claiming possibly the strait is closed. I think they're getting closer to getting something done, but it's just it's just a very complicated situation that's going to take time. This is the closing of the Straits of Hormuz has never happened. I mean, this was kind of the nightmare scenario, and the stock market kind of went right through it like it was nothing to see. And mainly because every time it was about to drop off, Trump announced an imminent meeting with the Iranians, and it was about to happen, and then it rallied back. And they were Scott Bessent we are so fortunate to have Scott Bessent as our Treasury Secretary, because he's been able to engineer this thing through and stabilize these financial markets. But one of the problems is, it's really, this war has been really nothing but good news for the stock market, because it's like, hey, this is, we're winning the war. We're wiping out the Iranians. So we know we're going to win. We know the war is going to end. So there's this huge good news balloon out there that everybody is focused on. And so they're not focused on the private credit issues. They're not focused on the inflation that's coming back. They're not focusing on the fact that, hey, the rates were going to be falling and now they're not. And they're not focused on the fact that the global supply chains have been disrupted as bad as anything since 2020, because the war is about to get solved and we're going to be a big win, and this is a huge event, and so they want to be in ahead of time. And so the problem you have right now is, where do you go from here? And I think a couple things have come out of this war, and the Ukraine war in particular, is the United States needs to reorder their entire military. I mean, it was remarkably successful, but we're flying around in $100 million, $150 million airplanes or more, and the Iranians are launching cheap missiles that they're mass producing, ballistic missiles, and dropping them in on Tel Aviv and U.S. bases and Arab energy installations. And so we had to, a couple things. We have to build a lot more missiles ourselves, because going forward, missiles are going to be a lot better thing. In order to keep the planes in the air, you've got to have the KC-130, 135 tankers flying around, keeping the planes refueled and stuff, monitoring everything. You got to send in some cases, we had to send planes over from the United States, and then companies like Spain and France were not letting us fly over their territory, which is just a disgrace. And so, but if you just launch the missiles, the Iranians were just dropping the missiles, and they were hiding in bunkers in the mountains and scattered all over the place, and we couldn't find them. And so we're going to need more missiles. We're going to need more hypersonic missiles. The hypersonic missiles, they kept our Navy a little further offshore than they would have liked. The other thing we're going to need millions of drones. The Ukrainians are taking some areas of the battlefield against Russia, not even using people, just using drones flying in and attacking anything that moves. And so we're really going to the Terminator type of warfare very, very, very quickly. I mean, we saw. I mean, it's remarkable that Trump can basically contribute a war with the biggest bombing campaign since Vietnam, hundreds and hundreds of planes and everything else. But if you land one troop in there, everybody loses one military person in the country. They lose their mind because we can't withstand any losses of personnel. So you're going to have to have drones. You're going to have missiles. You're going to have remotely controlled platforms. And that's going to be a better way to go. I mean, we'd have probably won the Vietnam War if college students had been protesting all over the place because they didn't want to go into the. It's not that they were hated war or anything; they just didn't want to be drafted, and so the United States is shifting over their military. I mean, everybody, the Ukraine-Russia war has been a laboratory. Anybody in the military will tell you that. They've all been studying it closely, monitoring everything, deciding how to fight the next war. So we're going to have to order millions of drones, tens of thousands of missiles. We need more ships. We need different types of ships. We need more aircraft. The other thing we're realizing is we burn through our missiles and our missile defenses. We need anti-missile missiles. We've burned through most of those. We're dangerously low on them between the Ukraine war and the Israeli war. And we said when the Ukraine war started, we said if a war broke out in the Middle East or in China, it could affect us. And at the time, nobody paid attention to it on the Max Out Savings Show. But so they're redoing the defense. President Trump has met with the automakers to say, hey, guys, look, maybe you could help us build up part of these munitions. One of the problems we have is we have these big defense companies. They've got cost-plus contracts. They get a bunch of – well, I won't say that. But they go, hey, we'll build out can you get this missile? Oh, yes, sir, Mr. President. We'll get it going. We'll start production in 3 years, and we'll have the contract. It'll take us another 7 to 10 years. So by 10 to 13 years, we'll have completed the contract. Well, we might have lost or won 2 wars in the interim. And so this is a big change. So the auto companies, well, you guys have assembly lines. Why can't you can knock out millions of cars? Why can't you knock out millions of missiles or tanks or whatever? The Iranians sat in caves and managed to build 10,000 missiles. I mean, honestly, a peace deal, I would make part of the peace deal that to send our military companies over to find out how Iran managed to do this, and we're looking like a bunch of idiots, turning out $10-20 million missiles, one at a time. And so there are companies in there that do some of these. I think we mentioned Klarman. There's some other ones out there. The AVAV. They make drones. There's different companies out there that do that. By the way, we're not in AVAV. We haven't studied it real closely, so that was not a recommendation. But there's opportunities. There's opportunities in if the car companies, which have just ridiculously low PE ratios on these companies, if you sit down and look at it, if these guys can start making military equipment, bear with me just a second. Let me pull something up here. Where is it? Okay. This is a live show, and so there we go. Okay, GM is $80, and they're projected to earn $12. So the company's at 7 times earnings. Well, if they could start building military equipment, they could boost up their PE ratio, and it could be a game changer for. We have to start using mass production techniques. If you look at what Elon Musk and SpaceX has done with the rockets, they've launched like 10,000 satellites. They're launching. I think it's over 85% of the payloads on planet Earth right now. He came up with this from basically a cold start and built reusable rockets that everyone said it couldn't be done. That's what we have to do. So there's going to be opportunities there. Data centers, more opportunities there. With AI, there's opportunities there. There's going to be with this new Mythos system. There's going to be opportunities in cyber because every company out there has got to double up their cyber operations because they have these new AI systems that are so fantastic that they can actually crack, not really crack, but everyone always thought the big danger was, particularly with quantum, is you can crack the encryption. Well, the problem is no one thought about, well, what if you had an artificial intelligence so powerful it can go in and exploit the vulnerabilities in the actual code? And so there's opportunities there. The build out of the AI centers. We're looking at some, maybe the AI companies more, because they're going to become more almost like utilities. And I think there's going to be such a demand for AI. The limiting factor is going to be the chips, but also it's going to be just the ability, the compute capacity. And then of course you've got the demand for copper, aluminum, a huge demand for aluminum for all this AI electricity build out. Well, 10% of the global production has been shut down for a month, and probably 2 months before it gets going. And the question is, how much is it damaged? So again, critical metals as well, silver, those type of things, aluminum, copper. There's still huge demand. So we have an economy that's rapidly shifting to a remanufacturing economy. President Trump is still fighting like crazy to get more factories back to the U.S. I mean, he has done a remarkable job of reshoring manufacturing, cutting federal employees, trying to reduce the deficit, coming up with ways to do it. Congress has been Congress has reached the point where they're almost obsolete because they're absolutely unable to accomplish anything. I'm not even convinced that a Democratic Senate is bad, because at least the Democrats are going to have to try to make a deal with Trump, whereas the Republicans are the adults in the room. There's a few, rhinos in there, and they're not letting anything pass, and it's a disaster. But Trump is bringing these factories back. He's working on reducing the deficit through tariff income, through trying to cut interest rates. They're fighting him on that. The factories are going to create more capacity, more tax generation, more growth there. So you have a lot of things happening. They're looking at some other very interesting things too. I was just going through a paper on the on trying to cut back the amount of cash. The U.S. does not get paid cash on their debt. On the money they have that sits in the Treasury General account, it doesn't collect any interest. They could maybe save $40 billion there. So there's a lot of potential opportunities, and it's all being kind of in the fog of war. People aren't seeing the good things that are happening to the country and the opportunities. And so I do think those are there, but I think in this world, you really, as we've said numerous times, have to really spread that risk out really across multiple asset classes and monitor the portfolios. The same thing with bonds. I still like shorter term bonds. We've been, for a number of years now, when rates were close to zero, we just said, look, we're just going to wait it out rather than buy long term bonds yielding 2% and be stuck with big losses in the portfolio. And the strategy worked out. And then in I think it was 2022, the markets just completely fell apart, in the S&P 500 in the Bloomberg bond index had one of the worst together returns since 1928, which is absolutely horrible performance. It was all because of the situation that was happening with let me see. So hold on just 1 second. It was all because of the increase in interest rates, and so that you have to be able to think differently. And we actually had a couple clients that just wanted nothing but treasuries, and we're like, look, the treasuries are yielding nothing. Why don't we put like 15% in gold? We're getting zero on our treasuries, and then we're super concerned, didn't want to do anything. And I'm like, figure in 5 years gold will go up a little bit. Well, the gold turned out to be a huge, huge return, and ultimately then the treasury yields went up, and it worked out. But you have to be able to think outside of the box in this type of market. It's a completely different market from what we've had in the past, and you have to be able to sit there and navigate through things, navigate through oil moving up, through precious metals moving up, copper, AI. There was a lot of these SaaS stocks which do a lot of the software companies. People are like, wait a minute, this AI can go and replace these things. I mean, one of the problems with Microsoft that we're looking at here is the reason Microsoft. Everyone I know does not like Microsoft. They're a pain to deal with. Their code is like 3 million lines. It's buggy. It's just no fun. The customer service is horrible. But they've got Word everybody uses, and they have Excel spreadsheets. Well, right now, your AI can replace that spreadsheet. And as people become more sophisticated using AI, the question is, are they going to continue to use Microsoft, or are they just going to use an AI to create the spreadsheet and handle it themselves? And that's kind of the question we're going to see. And so what you understand is this economy is going through a massive change. So we up against a break here. I'm going to go try to expand upon this after this quick break right here on the Max Out Savings. And if you have a question or comment, you can give us a call. Get in the last segment to 713-339-1070 here at the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
AM 1070, The Answer.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. I wasn't sure. Do we have a call coming in, a question or not? Was that yes or no? Okay. Hey, welcome to the Max Out Savings Show.
Hi, Ted. How are you today?
Pretty good, pretty good.
I have just a
What's
quick
up?
question for you. With all these problems that you're talking about in the private equity market, why am I not seeing it reflected in CD rates at the bank?
That's a good question. I tell you what. At the beginning of the show, I just mentioned, and I'm still working through the report, and I just caught the first 2 or 3 pages, and I was kind of really shocked on the balance sheets of these big banks. So much of it is so much of it is securities trading and government repos and different things like that. So I don't think it's affecting them yet. Most of the private credit. It's a good question. The private credit people really took away the lower quality loans from the banks. The ones that the banks really weren't sure of, or they were going to charge more because they just really felt it was risky. They took those things away from them.
Okay, so you don't see CD rates being changed significantly anytime soon?
No, I think. Look, I think as soon as this war's over, I think Secretary Bessent and the new incoming chair Warsh are going to push for slightly lower rates. I don't think they've given up on that thing. I think they're going to point out that oil prices have fallen and it's going to be going back, and they're really going to push for lower rates. Donald Trump really wants to get this deficit down, and cutting rates are a key component of that.
Okay. All right. Well, thanks very much.
Yeah, I mean, no, it's interesting because we haven't seen the CD rates. They haven't really gone up, but I think that when it comes to CDs, clients call up and said, "What should I do with my CD?" Generally, I say try to get 12 months to 18 months on the CDs. Because if rates fall, this way you're locking in something good. And honestly, if rates go up, by then you're going to get an idea what they're really going to do and can get a better return.
Okay, sounds good.
Okay, thank you.
Thank you.
But as we talked about, and I'm a little more suspect of the law. I think before this is all over in the future, they're going to engage in some type of yield curve control to try to keep the long end down. But so much of our debt is now funded on the short end of the curve, which is less than a year or 18 months. That if you can push down short-term rates, which is the one thing the Federal Reserve, they really can't control long-term rates very well, but they can control short-term rates. It's going to help out. So the point I want to understand is the world is changing. So much of this of the returns in the last 10 or 20 years have been built on financialization, on companies raising the price of their products, cutting the quality of their products. Now it's going to be on manufacturing. It's going to be on building. If you look at the companies doing really well, Tesla, the other auto companies have done horribly because they're busily doing a bunch of financial engineering, and Tesla's figuring out ways to make the car cheaper and thinking outside of the box. If you look at China had 20, 25 years of uninterrupted growth as they took all our factories from us and built them in China. Well, now we might not get 25 years, but we can get some good growth, or at least stable growth, by bringing all these factories back here. But they're going to be more robotic factories. Robots are going to be a big thing, I think, going forward. One of the big trends. Musk is coming out with his Optimus robots. He's cleared the decks, for the factory out in California for that. But it's other companies. They're going to be robotic factories and stuff to produce the products. Two reasons. We can make them cheaper that way. With robotics, we can compete because we don't need to compete as much on the cost of labor. And the other thing is we need to bring critical materials, critical products back to the United States. I mean, I think Jamie Dimon the other day made some comment that we've lost so much of our factories because they could go overseas and save $10 on making the product over there, and what they didn't realize is they lost control of the production, and they were at risk, and so going forward, the country's going to pay to reduce the risk of potential look what's just happened in the Persian Gulf. This has been papered over. It's not if you just go on X, there's the recording of the tanker captain pleading with the Iranians not to keep shooting at the ship. They're turning around. This is this morning. So, people are understanding if we go to war with China, a lot of stuff's going to be cut off. We're in competition with China. So again, war, defense, missiles, anti-missile missiles, drones, all these things, AI, reshoring in the factories. These are bigger issues out there that are kind of playing through. Now, looking at the market and kind of the euphoria we just saw, and clearly it's complete euphoria. I don't think that's justified at this juncture. I think we have a lot of issues to deal with. I think President Trump has done a very good job, but honestly, he's hurt himself with some of his tweets and different things. And as much as I like to kid some of my Catholic friends, I mean, picking the fight with the Pope was not the best idea in the world. I mean, of course, any Pope is going to criticize the war. Their job isn't war, it's peace. And so, I mean, I don't know how, and there's been just numerous other ones as well. And so he really, as good a job as he's doing, he's his own worst enemy. And we're going to have to really work very, very hard to try to hold the House and the Senate. And we have a lot to point out good stuff. And if Trump would just kind of rein in his tweets and try to get along with some people, at least his friends, I think it would really, really help out. So, so we have a lot of things happening out there in the world. I don't think this war with Iran is over yet. And what I'm very sure of is the consequences of the war, and particularly the consequences of the closing of the Strait of Hormuz, at best case, are going to go on for months. Someone was actually they were projecting $80 oil all the way into the year end, and I don't know if I have the curve here or not. Let me see here if I can pull that up real quick. I don't think I have that. I typically have I've got a curve. You can see the curve, and even the crude oil curve going out is just not that. It's just not that even out 6 months, oil is still over $80 because there just is such a demand for oil. There's such a shortage. As we said earlier in the show, our calculations, we've lost about 600 to 700 million barrels of oil production that aren't easily replaced in the world today, and now everyone's going to be scrambling. But the bigger problem is really jet fuel and diesel fuel in many countries is in critically short supply, and in some countries they're really Asia and other places that are really cutting the flights because they just don't have the fuel to run the flights. They have to keep a certain amount on hand, and so the tankers can get there. So these are big issues. We just are going to live in a much more inflationary world. There's always a lot of inflation because people, they're building AI centers, they're building new manufacturing facilities, they're building defense plants, and now you're going to have shortages. We mentioned earlier in the show, 10% of the world's aluminum production comes out of the Persian Gulf. Who knew? 30% of the helium. Who knew about that? And in some cases, some of these facilities are damaged. And so in the world, 30 or 40 years ago, we'd analyze stocks, 30 years ago. And many companies, they were almost like banks. They had so much cash, and they had real high working capital. And if you look at the working capital, there was a big chunk of inventories, and it's almost easier to see nowadays in the oil companies. But these guys had big amounts of inventory, so they would have debt, and then they'd have, they might have $1 billion worth of debt. This was back in the day, and then they might have $800 million in working capital, and a huge chunk of that was inventory or more. And in the last 20 years, corporate America has been run by chief financial officers. And so they're out there going, well, look, we don't need all this excess supply. We don't need this capital tied up in this. Let's cut our inventories. I mean, and it became really super clear was that when the pandemic hit, nobody had any inventory because they were running just-in-time inventory. And it was a disaster, as we pointed out at the time. Well, a lot of companies are continuing to do that. The companies of the future are going to be run by CEOs that are mechanical engineers, manufacturing, industrial engineering people. Those are the people that are going to drive companies going forward because companies of the future are all about technology, about manufacturing prowess, not about how much you can cut the cost of a price of a product or fire more workers to boost your margins. And so, again, this whole shift is happening there right before our eyes, and you want to kind of keep an eye on it. The old guard, the old guard of Wall Street running everything is dying off because it's been a failed system. So there are a lot of opportunities in the markets in here. And so we'll continue. I think you have to be careful up here. This market's had a huge run on the euphoria of the end of the war. It's clearly not over. This is a very difficult issue, and it's going to take time. And I think things have gotten ahead of themselves, and this should be some opportunity to maybe scale back some things and take advantage of things on the pullbacks. Again, you want to continue put your risk plan in place. If you need some help, we manage retirement money, trusts, long-term money at Max Out Savings Advisors here in Houston. We typically buy individual stocks, bonds, some funds, and put together a risk-managed program for you. If you need some help, go to our website, maxoutsavings.com. You can drop me an email or give us a call, request an appointment, and we'll be happy to sit down with you here in Houston and meet with you, and I'll show you how we manage funds. But at a minimum, go to the website, maxoutsavings.com. Sign up for our free newsletter. We send it out once a month. We talk about all these big issues. We try to make them concise and very simple and let you know how they're going to affect your life. It's maxoutsavings.com. So if you need some help, I'd like to help you out. Go to our website, maxoutsavings.com. Until next week, remember our motto and philosophy, which is to save aggressively and invest conservatively. That's where it all starts. That's where it starts to building up wealth. Save aggressively, invest conservatively. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
AM 1070.